Hello, everyone, and welcome to the webinar. This afternoon, we're going to be talking to you about building a private bank. My name is Joe Militello, and I'm the owner of Infinite Wealth. And we're going to teach you how to create that private finance company for yourself and your family. And it's a path to systematic riches. And on a personal note, before we get started with the webinar, I just want to let everyone know that I've got my own private bank, and I've had it for years, and I utilize it as much as I possibly can. And I tell you, it eliminates a lot of worry for the future and protection of my money. It's a very, very good place to build an investment and to create wealth in your life. And we're going to go over that in detail today. Now, I know it's during the day, and basically it's midday, and everybody's working and needs to get back to work. So I'm going to try to wrap it up within 30 minutes. We're going to make it a short webinar, and that way everybody can get back to work. And if anyone has any questions, of course, you can send some emails, or you can just contact our office directly. But having said that, let's get into the webinar. And this account is a properly designed account utilizing banking principles in the volume and the velocity of money. All right, and we're going to talk a little bit about volume and velocity of money today. We're going to teach you how to velocitize your money to maximize your profits using your own private finance company. Excuse me. But it's more than just a private bank or an account. It's an investment account as well. Okay, we use these as investment accounts, a retirement account, something you can plan for the future with. It also creates income for life. And we're going to talk to you about how to do that today with this type of account. And it has a lot of positive attributes, and we're going to get into those as well. And the attributes of this account, there's actually a long list of positive attributes, and we're going to try to cover as much as we can today. Today, you're going to get the Reader's Digest version, but I want you to get an understanding of why you need to utilize one of these accounts as opposed to putting your money in another place. And one of the biggest reasons, of course, is safety and predictability. With these accounts, and I already mentioned eliminating a lot of worry for the future, I know that my money's safe. It's principally protected, and I'm going to tell you why as we go through the webinar today. And I know I can gain access to my cash, which is also a very, very big thing. But these accounts you use in place of qualified plans, such as an IRA or a 401k or a SEP or 403b or a 529 plan, any qualified plan. And I say that for many reasons. One, personally, I don't like qualified plans because, and I know it's hard to say that. I don't want anybody to get offended because I know a lot of people have, excuse me, 401ks and IRAs, and that's a good thing if you don't have any other resources, okay? If you're planning for your future and you're trying to put something away and build some profit, some growth on that money, it's good that you're placing your money somewhere. But today we're going to talk to you about a better place, okay? When you contribute to a qualified plan, one of the reasons I don't like it, it's kind of locked away. You really don't have access to that money. You might have limited access to an IRA, but you cannot utilize it to create a private finance company, which is what we're going to teach you to do today. Again, liquidity, that's the big thing. You got access to your cash. Now, a lot of my clients that I've sat down with over the years, and we're talking dozens and dozens of clients, would have loved to have been able to gain access to their money. As an example, let's say you've got a 401k and you would have some credit card debt. And I don't mean credit cards that you use on a monthly basis for like gas and groceries and things of that type where you pay it off at the end of the month, but credit card debt, something that was built up over the years. And it doesn't matter how you got there or why, okay? The fact is, if you've got access to your capital, wouldn't you like to be able to or leverage your own money to pay off some of that debt? What if you could reach into your 401k and pull out $10,000 or $20,000 and pay off that credit card debt and then pay yourself back instead of the banks? Now, who's getting rich on that business model? You're paying your payments every month to the bank with high interest rate, by the way. Credit cards are ridiculous. I've seen clients with, outrageous interest rates. And if you were able to pay yourself back, how much more money would you have in your life? I can challenge everyone here today, including myself. If you added up all the payments you've made in your lifetime to the banks with principal and interest, as opposed to what you have put away, do they even come close? Do they compare? You probably paid tens of thousands, hundreds of thousands, even millions to the banks, as opposed to having a small portion put away in an investment account for your future and your retirement. That's a broken business model, folks. And I'm going to teach you how to avoid that, at least reduce that as much as possible, okay, through safety and predictability and the liquidity of your actual money. Also, these accounts create generational wealth for your family. So it protects your family and your estate. And I'm going to explain how that works as we go through it, okay? Another thing that I love about these accounts is it stops the wealth drains. And you might be asking yourself, okay, what is a wealth drain exactly? That's something we all suffer through. And I'm going to get into that right now because I want to point out a few of the downsides of what you and I and every other American out there face on a daily basis as far as debt and wealth drains and wealth stealers, if you will. That's what I call them, as wealth stealers. And wealth drains, that's basically, we call them wealth drains or a retirement killer. And that's what they do. They steal our wealth. And as an example, you're looking at the screen now, you're seeing what I have up there looking like a nest egg. Okay. And your nest egg is anything that you have that you're putting money away for. Your future, your retirement, whatever it might be. And again, it could be a retirement account, it could be a bank account, it could be anything. Okay, but it's where you're trying to maximize your money. You're trying to build up for your future. And that's what we're all trying to do. And we've all been taught to do that. Okay, we spend our lifetime filling up that nest egg. The problem is those wealth drains come into our lives, and there's many wealth drains out there, but the top four that you and I and everyone else out there contend with are taxes, market losses on our money, interest and fees to banks. That's that broken business model where the bank's making all the money and we're not. And depreciation. Think about the depreciation on assets. Cars alone steal tons of money from us because they depreciate, they get old, and they die on us. You know, we got to get new cars every few years, 5 to 7 to maybe 10 years. Or it could be business expense. It could be equipment. It could be business vehicles. Anything that you borrow money for and pay back interest on a depreciating asset is a wealth drain. We're going to teach you how to defeat some of that today, okay? Now, I already mentioned that list can get much longer, and it does. And just to give you a few examples, longevity for one. A lot of people are fearful of outliving their money. Loss of a spouse. Most people do not properly protect themselves from a loss of a spouse, whether they're still working, they're in their working life, or they're in retirement, either or. And we're going to talk a little bit about that too. Remember, we're talking about protecting your family and your estate. Terminal illness, again, another area that people do not try to protect themselves on because it's not expected, but it does happen. And when it does happen, we're not protected. And I've seen things like this, such as long-term care coverage, or I'm sorry, long-term care cost, wipe out estates, just liquidate them completely. And these wealth drains that you're looking at on the left side of the screen adversely reduce the amount of our nest egg or steal that wealth from us. Okay. Whoops. And you can see as that yellow line comes through, that's where it's being reduced. We're going from filling our nest egg up to having it stole away from us. And that's not what's going to happen here. We're going to teach you exactly how to stop those wealth drains and reverse the money flow, okay? So you can maximize that nest egg, all right, or your future retirement accounts. And I also want to point out one more wealth drain that most people are not really aware of. I know it's not top of the mind consciousness anyways, is that average rate of return. See, you and I and everyone else out there has been taught to chase that rate of return. Well, one thing I don't like about that is average rates of return do not add up to real dollars and cents. And to illustrate that, we're going to look at this small graph on the screen. And as you probably already have looked through it already, we're going to use a $100,000 example. And as you can see, in year one, it would go up 100%. Now, this example is a little drastic, of course, but we're doing that for the ease of the understanding, okay? A quick understanding on the illustration. At the end of year one, if it went up 100%, your account value would have $200,000 in it. And at the end of year two, if it reduced itself by 50%, you were back down to the original $100,000, okay? Well, it's going to go through and repeat itself. Year three, up another 100%. Year four, down another 50%. Now, the problem I have with this is at the end of year four, you are back to your original $100,000, but you're earning an average rate of 25%. Wait a minute. How does that work? It works just like this. This is how we get sold on these rates of return. You add up all your gains, and you subtract out your losses, and you divide by the 4 years that we've already been investing that money. And that's where you get your 25% average rate of return, but you still have the same account value. Now, that's why a 25% or any average rate of return does not add up to real dollars and cents. And the reality is that $100,000 account value is actually going to be even less because you're probably paying some fees to whoever's managing those accounts. And I want to just bring that to people's consciousness because to the top of their mind, because we've been conditioned. Everybody in America has been conditioned to chase that rate of return. And that's not something we want to focus on. I want to show you how to actually earn true growth on your money with no loss. That's what our focus here today is. Now, I talked about reversing the money flow. This is a quick example, okay? As you can see, the white dot at the top of the screen illustrates get my cursor here, your income. And a dollar sign is your income coming into your life. Now, the first thing that we're taught to do in our lifetime is to put some money away for our future, for our retirement account. And they tell you, oh, yeah, you got a working career now, so go ahead and put 10% of your income away in an investment vehicle. And for most of us, it's a 401k or an IRA or whatever it might be. It might be some stocks and bonds. Of course, everything is invested through the stock market, typically in mutual funds or money markets, unless you're an avid investor yourself and you like to invest directly into the market through stocks. But basically, the percentage of us are investing through qualified plans, okay? And the problem that we face is trying to put that 10% away after we're paying all those debt payments, that principal and interest. And it doesn't matter if it's a car, a credit card, a student loan, a business loan, business equipment, whatever it might be, that money is leaving our life. That's our wealth drain, okay? And statistically, they say, well, you're going to lose about 35% of your money because it's going to leave your life in the form of payments and principal and interest payments. Well, folks, I can tell you, I sit down with a lot of clients and I've taken a lot of applications over the years. And I can tell you that I can see this percentage here is usually much higher. It could be 45, 50% in a lot of cases. And I see it all the time. What if you were able to recapture that? What if you were able to just to recapture a percentage of that? Remember, we talked about the credit cards already. What if it was just car payments? What if you were able to pay yourself back? How much more money would you have in your life? And this example is illustrating that. If we could reverse the money flow and representing your income here, paying back to your private finance company, how much more wealth are you going to be able to keep into your life? It doesn't matter if it's credit cards, car payments, again, anything that you're borrowing money on, whatever that might be. I'll tell you what, you're the one that's going to start to build wealth now. You're not going to let the banks take it off from you. And that's very, very important when it comes down to your future and what your plans are for your future. Can you meet your goals, your wants, your needs? When you have safety and predictability, it's easier to plan for that. These type of accounts are a 770 account, okay? And it's in a guaranteed account, and it has tax favorable attributes. And we're going to talk about some of those tax favorable attributes because that is a big, big bonus when it comes down to investing money. Excuse me. The principal is guaranteed from loss. Inside of this type of account, your principal is guaranteed. You cannot lose any of your money. Contractually guaranteed from loss, okay? I've been doing them for years. I told you I've got my own. Never lose a penny, okay? And I'll tell you exactly how and why that happens. The growth and dividends inside these accounts grow tax-free. Again, another tax-free bonus for us. The income that's received, you can set these accounts up to either supplement retirement or to provide a retirement income for life. And that income received from that is going to be tax-free. These are the only accounts you can do that with. Besides a Roth, but again, a Roth is, I've had those. I've had both a traditional IRA and a Roth, and I can tell you these accounts will blow a Roth IRA away, blows them away. These accounts create high cash value inside the account. The cash value goes up every single year. You're actually earning growth on your money without the risk of market loss. Using volume and velocity of money, as we talked about volume and velocity in the beginning of the presentation, that's the speed of money. The velocity of money is the rate at which you can increase your money. And it kind of works like this. I can't illustrate it today. We don't have enough time for that. That's actually a whole nother presentation by itself. But think of it this way. If you were to put $100,000 in your bank account, you and I both know the bank uses our money and they loan it out. Well, let's say they loan out that $100,000 in increments of $25,000. Doesn't matter what it's for, they just loaned it out. Well, as the years going by, they're receiving payments back on those loans, right? Well, that income coming in will rebuild itself and restart to replenish that $100,000. Well, what the bank is going to do is velocitize that money to make more money. They're not going to wait to receive the whole $100,000 back. They're going to wait to receive another $25,000 and then loan it out again. So let's say 4 to 5 months later, they've got another $25,000. Well, now you've got 5 accounts making payments back. And again, before the end of the year, they're going to have more money. So they're going to loan out another $25,000. Now you've got 6 accounts receiving income based on $25,000 amounts. Now that's a lot more than 100,000, isn't it? That's how you velocitize money. It works the same with our economy. If you ever listen to our national economists that advise Wall Street and the governments, they talk about the velocity of our economy and money all the time. And again, folks, this is information that you can find for yourself. If you do the research, that's one of the reasons I like to open the doors, is to get people to open their eyes and understand there's a different way of thinking and there's a different way of actually protecting yourself as far as your money and investments go. It's an education process. You have to open your eyes and you got to take the time to teach yourself. Okay. Excuse me. Building massive wealth by leveraging your own money to self-finance, whether it's personal or business. You can create also tax-free generational wealth. And these are one of the only accounts out there that's going to be able to do that. Create tax-free income, but also tax-free generational wealth for yourself and your family. These accounts are properly designed. Okay. A 770 account has been used by corporations, banks, and famous family dynasties for generations. Generations have they used these accounts to build massive wealth tax-free. Okay. And they've been doing it for years and years and years. And I've got tons of examples for that. And again, this is not information that you can't get access to, folks. Do the research. You're going to be able to understand that. A properly designed life insurance account is not, we're not selling insurance. Okay. We're creating a vehicle to build an investment account, to build a private finance company. And we're going to use that to do the proper volume and velocity of your money. And to give you a quick understanding of where the banks put some of their money, we got a little chart here that shows you, and again, information you can get on your own, where they're putting and how much they're putting into high cash value life insurance. Now, banks are doing this. Now, we talked about banking principles. If we're going to apply the volume and velocity of money, don't you think we should apply some more banking principles? If banks are putting billions of dollars into high cash value life insurance accounts, don't you think we should be following suit? Bank of America, as of last year, 17 billion. JP Morgan Chase, 12 billion. Wells Fargo, 7 billion. US Bank, 6 billion. And the list goes on and on and on. In total, that list is in excess of over 4,000 banks, and they all utilize this strategy to put money in high cash value life insurance accounts. And to give you a quick example, this is what it's going to look like. A better understanding anyways. If you see the little chart at the bottom, that rectangle represents a life insurance contract. Let's just look at it that way. The top portion, of course, as you see, is insurance, and the bottom portion in the blue is your cash value. Now, let's say you started your finance company. And again, you can start your own account with any amount of money, okay? It could be a large amount of money or it can be a small amount of money. Depending on what you're trying to achieve or how much capital you have available to, we can work on that with you and teach you exactly how to leverage that so you can maximize the profits on it. But just for the understanding, you're going to start your account, you'll put X amount of dollars in, and you'll have life insurance, which has a death benefit, plus you're going to have your cash inside the account as your investment account. That's going to earn growth. These accounts earn guaranteed growth. And I'll talk a little bit more about that in a minute. But the way this is going to work, you treat it just like you would a normal retirement account, any kind of a qualified plan, a 401k, an IRA, and you contribute to it every year, just like you do your 401k. So if you were to illustrate that, I lost my screen here. Let's go back. There we go. If you were to illustrate that inside money going inside of your life insurance contract year after year, and as you can see, this is your chart that's going to increase. This green portion, of course, is profit. That's pure profit. The blue portion is money that you had put into your bank, and the green portion is all profit. And the reason why we illustrate this with a linear growth is because the money's principal protected, and you also earn a guaranteed compounded growth on your money year after year. Compounded growth is interest upon interest. It's not an average rate of return. It's actual true money. And it's compounding, so you're actually earning even more because each year the interest is compounding on top of the prior year's growth. So it's interest upon interest. So as you can see, the way that we build these, now these are properly designed accounts. This is not just a standard insurance policy. We don't use those. I build these as a hybrid type of an insurance policy. It's a 770 account, again, which has been used for generations. And we have the availability to structure these accounts to build high cash value. Again, it's not built for insurance. It's built to increase your capital. But because it is a life insurance contract, we do put insurance on it, and it has a death benefit. Now, the way these accounts work, the actual cash value has to have a corresponding amount of life insurance. And again, that's the white portion here. If you're looking at this graph, you're going to understand that when your money grows year after year, so does the death benefit, which means when you start your contract, you start off with a certain portion. Let's say it's 200,000 or 500,000. It doesn't matter how much. It will increase year after year as your account increases. So by the time you get to retirement, your death benefit might be $1 million, $1.5 million, $2 million, depends on where you started off at, okay, and how much you use to self-finance with. Folks, this is an unstoppable account. This is 10 times better than any qualified plan that you can ever use. Your money's safe. You don't have the roller coaster ride of the market. You don't have to fear any of the risk of that market crashing on us again, like it did in 97, 98, in 08, and 09. Okay, I was part of that. I felt the effects, and so did many, many of my clients. Okay, with principal protection, you're not going to lose that money. Now, I'm going to go over some of these attributes with you right now. Let's talk about them. As we're sitting there looking at the graph, we might as well get into them, right? No risk of principal loss. I already told you, contractually guaranteed principal. You cannot lose 1 penny of your money. Contractually guaranteed growth. You're going to get paid compounded growth every single year. The earnings inside the account, your growth and dividends, are going to increase tax-free. You can access your money anytime for any reason without any restriction. No penalties, no taxes, and no restriction. You use your money for what you want to use it for, okay? You want to take it out to buy a car. You want to self-finance your car. You want to self-finance another investment, such as real estate. I've had hundreds of clients to this day, and we do it all the time, is they pull money out to buy investment properties. And we're assisting them in that strategy. Every week I'm working on a new deal for a client. That's when you're double dipping your money. That's just, again, that's another presentation. But that's something we can talk about one-on-one. You just get a hold of me at my office, and I will teach you how to invest into the real estate market as well, using your own private finance company. One of the things that I like, especially being a self-employed individual, excuse me, is this lawsuit judgment and creditor proof. You have to understand that these cannot be touched. Okay, if for some reason anybody suffered the ill fate of a lawsuit, which, knock on wood, I've never have. But, anything can happen in this world today, and we all know that. You can't touch anything inside of a life insurance contract. In the state of Michigan, it is 100% protected, okay? That is a huge level of asset protection, okay? It recaptures principal and interest tax-free, goes back into your account, and we'll teach you how to do that. Easy access to capital for the rest of your life. Again, like I said, you don't have to go to the bank. You go right to your account, pull the money right out, and treat it as your own bank. You're in total control of what you're using money for, whether it's personal, business, or investments. You've got ability to put large sums of money into your policy, unlike qualified plans. One of the things that I love, an IRA, you can't start with more than $5,000, okay? You can dump $50,000, $100,000 into one of these accounts day one, okay? You've got much more flexibility. We're not under the scrutiny of the government, under their qualifications and or the fines and taxation, okay? Money passes tax-free to the heirs. if you leave more money behind than you have in your account. Excuse me. That's one of the things that I love so much about this. Excuse me, folks. I apologize. A little bit choked up here this morning. It's kind of dry in this office. Anyways, with that death benefit, you can have 3 to 4 times as much money in your account. See, it's an automatic estate creator from day one. You could have nothing and in one day execute a life insurance contract and have a $500,000 estate. How does that sound? That is fantastic. I've got it for my family and I love it. And it has not failed me in any single way. You choose the repayment terms on any loans that you might take out. If you take money out, you're going to choose how you're going to pay that money back. Okay. That's totally, you're in control of all of it. That's totally up to your discretion. Guaranteed insurability for life. Now, this is one of the things that I want to address really quick because people have this ill-fate, ridiculous notion because they've been taught by some of the so-called gurus out there to buy term and invest the rest. Well, you're only buying insurance and we're not doing that here. And again, term is only, it's just that. It's for a period of time. And the reason why term is that way is because less than 2% of the term policies ever get paid for or are paid out on. Let's put it that way. That less than 2% of death benefits ever get paid out on. And they know that before they even sell you a term policy. That's not what we're doing here. We're building an investment vehicle that will have a death benefit for life, and it's guaranteed. Plus, you combine it for any investments, like I already mentioned, real estate being one of them, and you can create massive growth inside these accounts. I've done it myself. I've self-financed cars. I've paid off debt. I buy real estate all the time myself, and I invest in it. And I use my private finance company to do so. And I doubled it my money. Everything's going back into my account. So I'm earning interest and I'm collecting interest. This is one of the most powerful accounts that you're going to be able to utilize for your retirement with safety, predictability, liquidity. Okay. Anything that you're utilizing now, I talk to people every day, folks, that are losing money. Stock market's up one day. Everybody's great. Oh, no, I'm doing fine. Until I talk to them 3 months later and, oh, God, the market came down again. I lost money. Are you tired of that? Do you want the safety? What about the access to the money? Do you want to be able to get access and self-finance? How would you like to pay for your own car and collect payments back to yourself? This is an unstoppable account that builds massive wealth inside of it. So that's our short presentation. There's a lot more to these. They can get a lot more detailed. I just wanted to give you the Reader's Digest version today so you can have a quick understanding of how to start your own private finance company. Get in touch with us. You got any questions at all, give us a shout on the phone, office line, 586-200-1033, or just send us a quick email at info@infinitewealthinc.com. info@infinitewealthinc.com. And we'll be available every day, Monday through Friday, to answer any questions you might have. Okay. Thanks for watching and enjoy your afternoon.